call a coiled spring. And I'm telling you, ladies and gentlemen, mark my words, and I've had enough words over the last 3 years with different companies and different stocks. When I say something, in many cases sooner, and in some cases like this one later, it plays out, and it plays out as expected. So the key thing about this process here is you get your first flush, your panic, and that's kind of like what we refer to as the left shoulder, okay? And this is a technical pattern that's, you don't make the bets on the basis of it, but when the business stops trading in relation to fundamentals due to some exogenous headlines or temporary nonsense, you can use this as a guide for sentiment. So you have your left shoulder, which is panic. You have your head, which is the flush low, which is discouragement. Then you shoot all the way up back to breaking out here, and everyone gets nervous. This is usually where money starts jumping in, and then they get flushed out, and they stay back down in inversion for a little while, which is what we call the right shoulder. So left shoulder, head, right shoulder, looks like inverse head and shoulders. And then finally, you work your way back up to denial. You get some consolidation back up here at the breakout level because this is where all the volume is. And then once it gets through here, it just goes straight up. And the interesting thing about it is between here and here, usually the fundamentals don't change very much because here you are paying too much for the same fundamentals. Here you are paying way too little for the same fundamentals. And then, by here and here, maybe the fundamentals start to improve a little bit. But once you get up to here, people are paying too much again. But they're doing it because they feel like everyone else is doing it, and it's the herd mentality. So why am I spending 3 minutes on this yet again? The reason is remember, shoulder, head, shoulder, and this is the breakout level. Well, what's Baba done in the last week? Because I must have 8 questions on Alibaba. One of which is, when would you give up on Alibaba? Which is the same question we got last week. So we know what sentiment is. Let's look at what price is. So all of the questions in the last few weeks around Baba have been very negative. But what has actually changed? And this is what's important. Here we are with the left shoulder, which was put in last March, okay? Then you had this move back up here. Then you had the flush all the way down to discouragement in October when the stock got down to $58 and people were puking hand over fist. We bought a slug at $61. And then what happened? At 121, everyone was excited. The thing went up 100% after the dollar peaked and started to come down. It went up 100% in 3 months. And that's what I say, when it comes all at once. And sure enough, that was enough to suck everyone in who sold at $60. They probably bought in here in the hundreds. They flushed out at $58 and $60. Then they're like, oh my God, I missed it. They bought back up after it was up 100%. And those people have to get flushed because, as you can see, there was a tremendous amount of volume at that level. Look here at volume by price. So now what's happened? Well, we're putting in the right shoulder, okay? Just as the left shoulder was sloppy, you had 2 moves to make the shoulder. The right shoulder is sloppy, and you have 2 moves to make that. But in the scheme of things, the price of the stock has done absolutely nothing since last March, and it's following the normal shakeout process, shoulder, head, shoulder, to get everyone out. And right now, the fact that everyone is panicking once yet again at the exact wrong time, I think we're literally on the cusp of this. Now, the other thing you have to keep in mind is, just like you're seeing Cooper Standard get bid up into the end of the quarter because it's done well this quarter, so people are chasing and pushing it up into the close so they get their marks high. You're seeing the same with Alibaba, which hasn't worked this quarter. No one wants it on their books before the 30th of June. So after you come home from the 4th of July holiday and you play plenty of great golf and shoot your best rounds ever, you'll come back and there'll be some ridiculous headline out of Hong Kong or China that the Chinese government has elected to buy stocks, or the Chinese government has elected to offer tax incentives for individuals to put stocks in a retirement plan, a tax-advantaged account. Or you'll hear, we'll get the inflation data in the U.S., which, with a headline of mid-threes, and everyone will know the Fed is finally done, the dollar will shoot lower, and emerging markets will all get bid. So this is not unique to Alibaba. The reason we chose Alibaba is because Alibaba has the best underlying fundamentals, and we know we have a margin of safety. But you could put emerging markets in the same chart, the EEM, you could put KWEB in the same chart, KWEB, you could put Tencent. All the charts are pretty much exactly the same thing. And the difference is we think we have the highest quality business of all of the businesses available in the emerging markets. And this is where we are in the process. So for those of you who are not happy because it's June 29th and it's probably going to look like crap tomorrow on June 30th as well, just know where you are, step back, zoom out, and know this process repeats over and over and over as long as you have a good quality business. So my bet is, of the 6 or 7 questions that I got, I'm going to bet that 3 to 4 of them have done exactly the opposite of what we've taught on this podcast for the last 4 years, which is they have gone in on margin. And if they've done that, then shame on them. And, you can't be any clearer. You can lead a horse to water, but you can't make them drink. You buy high quality businesses, but if you're levered up on them, then it's on you. And probably levered up at the exact wrong time at 120. Now they're bleeding here, and hopefully they can hang on if we retouch 80 before we blast off to 120 and beyond. And then finally through 120, which is when we start to go straight up. So that's where that is. So hang tight. Nothing's changed. If anything, the 618, the volumes were up 14.8%. We're seeing other headlines, which we'll go through right now. The business has gotten better. The price has done nothing. And it's what we call a coiled spring. And I'm telling you, ladies and gentlemen, mark my words. And I've had enough words over the last 3 years with different companies and different stocks. When I say something, in many cases sooner, and in some cases like this one later, it plays out, and it plays out as expected. So this thing is a coiled spring. Now, I want to put this guy on. I thought he had a good short clip here. He's from Joe Nagai from McKinsey China, laying out the case for China in the face of renewed pessimism again. Because remember, opinion follows trend. As a matter of fact, I'm thinking about making baseball hats that say hedge fund tips on the front and opinion follows trend on the back. Maybe we'll do that. But here we go. Let's take a listen to this. Joseph Nagai from McKinsey China.
So I think it really depends on whether you're a glass half full person or a glass half empty person, right? I think on the glass half empty side, I'll go there first. I think you look at all the challenges that China has, right, in terms of right now, there's a bit of overcapacity, right? A lot of the export sectors are quite hit by, a slowing world economy. I think you look at the capacity of, residential, real estate and others. The margin compression right now is really being felt by all businesses, right? So I think if you take all these problems that China has and put it all in the short term and feel like, hey, when's that going to be resolved? I think you can actually have a quite pessimistic view. And I think that's a little bit of what a lot of businesses expecting coming out of COVID. The big rebound is not happening, right? So that's a kind of glass half empty view. On the other hand, 18% of global GDP today in China, growing at 5% this year. It's a third of global growth, right? I think from that perspective, there's no other economy of this size that's growing at this pace. So on that side, many of the macro factors that we love about China is still very much present. So if you look at that perspective, I do think that China still represents probably one of the most unique markets for anyone operating in the global economy today.
It's very important to put it into context, particularly when you look at the contribution to global growth, as you have pointed out there. But when you lift up the hood and you take a look at where those growth drivers are actually coming from, what are you seeing? Because Goldman Sachs, of course, saying that China perhaps doesn't want to rely on the old playbook of the property sector anymore. We're seeing the stimulus coming through, but investors seem to be disappointed with the lack of specifics around that.
Yeah, look, I think that we need the consumption in China to come back up, right? In the last few years, Chinese savers have saved up 33 trillion of RMB, right, in deposit savings, more than ever before, right? If you look at a lot of the banks today, you see that, residents of China are actually repaying their mortgages, right? So the deleveraging on the consumption side is actually happening. What we need there is a little bit of a confidence, right, where people are willing to spend again, where they feel like there is going to be a little bit more optimism, right, in the market. And I do think that I hope the consumption will come back more. The other one I think is very interesting is that China is still very much at this stage of innovation and technology, driven economy. So if I look at electric vehicles, if I look at solar and other sustainability, right, if I look at even recently, a lot of Chinese exports, right, going actually outside in terms of technology. I mean, the interesting thing is that in the past few months, the top 3 apps in the US downloaded are all Chinese, right? So I think that there is quite a lot going on in there, and I think that is really being discounted by the market right now.